The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
Well, this is the end of the year, 23. So it's time to take a look back over our shoulder and see what actually happened. One thing you don't want to do with investing is use your rear view mirror, but every now and then it's time to just take a look and remember when. And there were a lot of things to remember this year. One of the things that has surprised most everybody in the financial services business is how much money has flown into exchange traded funds while massive amounts of money were flowing out of stocks and some bonds. But the money leaving the market has been much, much greater than the money coming into the market. But the magnet for investor money has been exchange traded funds. That has been the primary beneficiary, and they have become the fund sponsors have become major buyers particularly in this last rally, but throughout the year. When you look at who's buying stuff in the market, it's institutionals and exchange traded fund sponsors. They are dominating this market with about 80% of the activity. Individual investors and their brokers or their financial planners have not been heavy investors so far.
They're trailing, and of all the new money that is coming into the market on the fund side, it's all going into ETFs. Mutual funds are virtually attracting no new money. They're sitting on money that they've accumulated over decades. All the new money coming into the market is going into ETFs.
The only exception there is a lot of the older 401k plans are still mutual fund oriented.
They're still mutual fund only. Yeah. And those are getting farther and fewer between too. So. And that's a good thing. ETF is just a better product than a mutual fund. It's just the whole structure is in the investor's favor much more than mutual funds. And it's not that mutual funds were evil from the outset. That was just the best game in town for a lot of decades. And now that's just turned. There's a better product out there, and that's what ETFs are.
Well, mutual funds began back in the 20s. And unless you're a collector, nobody's driving a car from back then.
Yeah, no, they got a little better since then. Yeah, so
we are fiduciaries in every client engagement, and we manage as fiduciary advisors to trustees for 401k plans, and all of the plans we are responsible for are funded with exchange traded funds. One of the reasons is that if you want to buy index funds, they're less expensive than virtually all mutual funds. And you know what you're buying. There's no funny accounting on actual underlying assets. One of the concerns over this past year has been the massive increase, at least that's the way it's represented, in consumer credit card debt.
Ah, yes.
That debt has increased significantly over the year, and the corollary that goes along with that is consumers in trouble. That means that the market cannot go up any higher. It has to collapse because the consumer is going to run out of money. It's true that it's much higher than it was a few years ago, but we had a massive influx of cash from the COVID deals. We're really back to a level based on incomes. We're back to a level that's comparable to pre-COVID data. Incomes are higher. You would expect credit card debt to be higher and there's no trouble economically on the household because their incomes are higher. When incomes drop, that's when the household debt, the credit cards become the way of survival, and that leads to economic trouble.
Yep.
So nobody in their right mind wants the economic growth of the economy to slow down, unless of course you're at the Fed.
Unless you're at the Fed. Which is what they're trying to accomplish, right? They're at odds with everyone else who wants the economy to keep booming along, but the credit card debt credit card debt had been actually very, very low. It was down. People's balance sheets were very, very strong. It's kind of running back up to a more normal level. Like you said, Don, it's kind of returned to pre-pandemic levels. So it's not really a huge indicator of like you said, economic turmoil for households, just kind of a return to normal. The only bad thing is, the average interest rate on those are running around 22%. And that's that's steep interest. So you don't want people to get in trouble with rates that high.
Well, that's true, and there's a corollary for that with the small businesses. Small businesses have had a series of years of, well, almost a decade of near zero interest rates. So the average small business debt that's going to renew in 24 is a debt obligation on an average interest rate of about 2.8. And when it
Right.
renews this next year, it's going to be renewing at more than 5. Essentially, it's going to double.
It's
And
going to double.
small companies have a hard time raising that kind of revenue. So we would expect to see some increase in bankruptcies among small firms as we go through next year. And as we look back over our shoulder, prior to COVID, commercial real estate was a way to generate significant income, cash flow returns.
Yep.
COVID changed the name of the game, and those property owners, those real estate trusts, are facing the same kind of problem as small businesses. They have cheap debt that's going to roll over at a higher number. They have low occupancy because they can't get people to come back to work in the office. And
Correct.
employers initially started threatening people. If you don't come back to work, I'm going to fire you. Well, I said, okay, I can get another job someplace else. No big deal. I like working from home. Employers lost the bluff. It didn't work. So occupancy is going to be a problem for real estate going into next year. And the assumptions, this is an area where when you look back over the way things have been, you can't use that data as an assumption for what's going to happen in the future. You need to be more specific about what you're looking at. One of the problems over the last several years has actually been rising interest rates, and it has
Right.
decimated bond investors. It's been extremely hard, even for the risk managed accounts using a balanced strategic portfolio, a 60-40 portfolio, for instance. And until just the last couple of weeks of December, it looked like it would be the third consecutive year of negative returns in the bond market. But Chairman Powell's speech in the middle of December changed the game, and there's hope. Well, hope springs eternal for lower interest rates, which would bring up values, raise values. Bonds are a teeter-totter, rates on one end and values on the other. Rates falling is good for bond values, bad for people who want high interest for income. It's a trade-off. That's a major change. In 100 years, we have never had a series of bad bond returns like we have the last 3 years.
And
It's an
that
outlier.
goes to show you how out of whack the entire investing sector was. I mean, nothing was really true to form. It's been so difficult being a professional money manager for the past few years because nothing is working. All the market correlations, the sector correlations, everything kind of broke free, and everything moved in its own way because with all the government intervention, investment markets were just fragmented, and this little piece was working great, and that should mean this other piece is not doing well. That didn't work out the same. Nothing held suit anymore, and it's been crazy. And now if we can get the Fed back to a more normal interest rate environment, boy, that just helps everything work more naturally, more organically, as the investment markets usually do. And so first they were abnormally low, and then rates got abnormally high, and now it looks like finally we're going to get some moderation, and that's good news for everybody going forward.
So throughout the year, we have had, coming from the Fed, the mantra that it's higher for longer. After
Yep.
they got after they got the transitory inflation story wrong, they
Completely.
jumped
Yeah.
in with both feet to raise interest rates. We've never had a Fed raising rates as rapidly to the extent that they have in this last run. And
That's
that
right.
persisted until mid-December when President Biden's approval rating fell below Kamala Harris's approval rating. And suddenly the Fed changed its tune and said, higher for longer is dead, and we're going to cut rates 3 times next year. Now, I'm sure it had nothing to do with the fact that approval ratings on the president had plummeted so severely,
Nah.
because the Fed tells us they don't make decisions based on that data. That's a data
They
point
don't.
they
They
ignore.
do not succumb to political pressure. That's right. That's right. It's just data.
I don't have the chart for it here, but if we go back and look at Fed cuts or Fed actions in presidential election years,
Yeah.
it's going to be really hard to argue that they don't respond to political pressure.
Yep. They're as human as everyone else, and as much as they like to say they don't, the chairman of the Federal Reserve serves at the whim of the president of the United States, and that's just the way it goes.
Well, and with regard to Mr. Powell, he was still in the transitory inflation scenario until President Biden reappointed him. And then it was suddenly, no, this inflation really is a problem. Now that I have job security, I can say
Now that
so.
I'm staying, yeah.
Yeah,
Maybe we
I
should
got
deal with this. Yeah.
I have 4 more years to build my pension. That's right.
Uh, a little spooky, but it's a little true.
One of the other big changes is the decimal point on interest rates changed radically. For years, interest point has been 0.5
Hmm.
or 0.25 or 0.01 if in the money market or your bank. And
Yep.
this year, the decimal point moved to 5%, and in some places even higher. That's a major shift in treasuries. That's the first time since March of '07, prior to the financial crisis, that interest rates have been that high. And they still are persisting in that range with inflation around 4 at year's end here. Rates can still be found pretty close to 5. You have to be careful on what's called duration, how long out
Duration.
you
Yeah.
are in the future, and
Yep.
the risk profile of what you're investing in. Treasuries are a little lower than 5 because you're lending money to one of the world's largest bankrupt entities, and that's secure because
So
they
it's
can print
safe.
more.
Yeah.
Yeah, say they can print more money. We
Yeah.
If the Fed is correct and they lower rates, that 5% is not going to persist forever. And anyway, as we look at the Magnificent Seven, which have had a lot of press, whether it's financial media or not, they have attracted attention because there've been 7 stocks that have driven the Nasdaq and the S&P 500 higher most of the year. Didn't last all year, but it was most of the
Right.
year. That's basically been those 7 stocks. And that is changing. That has changed in the last half of December. They've basically started moving sideways as money is going into a more diverse part of the market. Let's hope that this next year is not what happened after the big tech run up of the late 90s, where we had a flat year of sideways consolidation and then falling off the cliff. We got too close to the edge and it collapsed. Uh,
Right. And
so
we don't think that's going to happen, but that is the last time we had a huge tech run up. Of course, we saw that. That one was different back in the late 90s. That tech run up was largely speculation, and there were plenty of companies that weren't really companies. They just had a great .com address, and that was it. You know, billions of dollars would pour in. We're not looking at that right now. Every one of the Magnificent Seven, of course, has a global enterprise that really is a huge business, and so there's not as much speculation, and there's significantly less risk of the bottom just dropping out at this point in time. Even though they can still have a drawdown, they're just not going to disappear.
no, the question is who's going to replace them because
Yep.
those
Yep.
business models are multi-decades old. I mean, we can
Getting
go
old.
back
Yep.
into the 70s for the startup situation, and then they became market companies
Sure.
somewhere in the early 80s typically. And so we're looking at 40-year-old companies, and they don't maintain dominance forever. Some small startups going to finally do what Bill Gates did to IBM when he brought Microsoft to life, and
Yep.
he knocked IBM off the pedestal. They just they took their eyes off their job, and that's going to happen here again. One of the other things that changed that wasn't seen since the 70s, and that was 8% mortgage rates, which in
How
the
about that?
70s to the 80s, those rates continued to accelerate all the way up to 21% in a fraction. I said that right,
That's it.
21%.
That
And,
really happened. Yeah.
and it was in that environment that Paul Volcker said, we're going to change the way this game is played and knock inflation on its backside, which he took two different attempts to accomplish. And that's part of Mr. Powell's concern right now, that he doesn't follow the same example that Paul Volcker was facing back in the 70s and early 80s. The good news is we topped out in the 8% range, and that the recent news with Powell's last speech is that
Yep.
rates have fallen into the mid sixes, and that has sparked optimism for a lot of house buyers, home buyers, wannabes, and for the home construction industry. It has not, however, solved the lack of inventory of existing homes. Because for those who have a mortgage that is, say, 2.5 to 4.5%,
Sure.
going to 6.5 is still a nasty situation. They're not
Yep.
selling unless there's a critical event, job change, death, get close to grandkids, health change, I can't stay here anymore. A critical event that says, I have to sell, I just can't stay. That'll come on the market. But to swap a house with a mortgage that's double or triple your current mortgage rate, it's not very attractive.
Tough sell. Yeah.
Volatility has been pretty high in the areas that we don't usually expect it. That's been in the bond market. But frankly, as we go forward into 24, if the Fed changes its mind on any one of the three interest rate cuts, expect volatility to accelerate in the bond market and carry over to infect the stock market. That would not be good news, because the assumptions are that the rates that have been falling so far this year are going to continue into next year. And if they do, that supports the assumption that markets will move onward and upward before we get at least some profit taking. Maybe not a severe correction, but
Sell off. Yeah.
anytime you get a good run in prices, you have to expect there'll be some pause, a consolidation in trading patterns, and some profits will come off the board. Anyway, it's been a tough year unless you owned a handful of stocks and you ignored your risk exposure. Going forward, it looks like things are changing, and it will be a more comfortable market. And those who have been sitting on the sidelines with more than $1 trillion of cash, we don't expect it all to come back in, but a ton of it will on a FOMO trade. That's fear of missing out. The market's going up, my 5% interest rate's no longer available, and I'd rather have the stock market return than watch my interest rate income continue to decline. So, Perry, you have any closing thoughts on where we are as we wrap this one up?
No, I'm glad 2023 is done. Every year is going to be brand new. I think from now on, everything's changing so fast. So, buckle up and don't expect an easy year. There's going to be things that are going to pop up that no one saw coming, but we made it through 2023, and we'll make it through 2024.
So God bless you and your family as we start a new year. That's it. That's it for us. Subscribe to our YouTube channel. The subscribe button's down below. Give us a call if you want to talk about your condition and portfolio. Have a great, happy new year.